You see it everywhere, don't you? Those dazzling before and after photos, the big reveals on the renovation shows.
Oh, yeah?
That SOLD sign, standing next to a perfectly polished house. It kind of whispers of a quick win, right? A big payday.
It's the dream.
It really is for so many people.
Yeah.
House flipping. The idea seems simple enough. Buy low, fix it up, sell high. Make a tidy profit.
Sounds straightforward, almost glamorous even.
Exactly. But maybe step back from the TV screen for a second. You have to ask the question that's bouncing around the real estate world right now. Is that shiny picture still the reality? I mean, in the U.S. market today, can you really still make serious profits flipping houses here, in 2024 heading into 2025?
Or have things gotten too tricky? High prices, rising costs for renovations, higher interest rates.
Right. Has it just become too risky for, the average person trying to get in?
That's really the million-dollar question, isn't it? Literally, sometimes.
Yeah.
For anyone even thinking about this path. Because the market today, well, it's undeniably different from that superheated environment we saw just, a couple of years ago.
Totally different world.
Yeah. And flipping, it's not happening in a vacuum, right?
Yeah.
It's directly tied to all those bigger economic currents.
Exactly. And that is precisely why we're doing this deep dive today. We really want to cut through the hype, peel back the layers.
Get down to the studs, so to speak.
Yeah, exactly. Get down to the bedrock of house flipping in the current climate. We've pulled together a whole stack of sources like detailed market reports, just packed with stats on activity, profitability, how different regions are doing, financing methods.
Plus, we've got expert analysis really breaking down the risks versus the rewards. Some strategic insights on how the savvy investors choose where to flip.
And even some really candid perspectives pulled from actual flippers sharing their experiences, the wins and the losses, in places like online forums.
Yeah, the real ground truth. So our mission here today with this deep dive is basically to give you a clear-eyed, really well-informed look at the actual landscape.
No sugarcoating.
None. We want to quantify the potential rewards, based on the latest data, but also lay bare the very real, very significant risks you absolutely have to understand.
That's so crucial.
And show you what the data tells us about which markets are working best right now for flippers. And frankly, which ones aren't.
And maybe uncover some of those key strategies the successful investors are using right now to navigate this kind of environment.
That's the goal. Think of this as your reality check on that flippin' dream.
Okay.
We want you to walk away really understanding what it truly takes to flip a house profitably today, armed with the info you need to honestly figure out if this, pretty demanding path actually lines up with your goals and, importantly, your tolerance for risk.
Okay, let's unpack this. Where do we start? The appeal.
Yeah, let's start there. We have to acknowledge the powerful allure, right? It's not just the money, although, let's be honest, that's a huge driver.
For sure.
But there's also this deep satisfaction in taking a neglected property, something run down, and just bringing it back to life, transforming it.
Making it beautiful again.
Exactly. Into a functional, beautiful home someone new is going to love.
Yeah.
And the TV shows, social media, they're constantly showing these incredible before and afters. It makes it look not just profitable, but also, really rewarding creatively.
Totally. It taps into that desire we have to build something, improve things, create something tangible and valuable. And the basic process, on the surface, it does seem pretty simple, doesn't it?
It does. Find a house that needs work, buy it, fix it up with some smart renovations, then sell it for more than everything cost you. Simple, right?
Sounds easy when you say it like that.
Yeah, but that's where, as the sources really hammer home, the beyond the glamour part kicks in.
Right. The reality.
The journey from before to after is actually, it's a complex process. It's filled with all these intricate details. It demands really precise execution. And crucially, there are significant risks. Risks that can derail even the most careful plans.
It's not just about picking paint colors then.
Not at all. It's a business built on meticulous planning, budgeting, project management, not just aesthetics.
But okay, despite all those complexities, those risks, people are still doing it. Clearly. And the sources do highlight some powerful upsides that keep attracting investors.
Oh, definitely. The potential for high profit is probably number one, making a significant chunk of money relatively quickly.
Compared to what? Like long-term rentals?
Yeah, exactly.
Yeah.
Compared to, say, the slower, more gradual returns from a rental property where your profit comes in bit by bit over years of collecting rent, flipping offers that potential for a faster lump sum.
Okay. And what else besides the money?
Well, Beyond the immediate cash, the sources point out something really valuable. Every single project, whether it's a huge success or, frankly, a tough lesson.
You learn something.
You learn so much. Invaluable practical experience, hands-on knowledge of construction, dealing with contractors, understanding market dynamics from the inside out, negotiation, budgeting, managing a project.
Skills you can use elsewhere, too.
Absolutely. Highly transferable skills. It serves you well on any kind of real estate venture or even other businesses. It's like a crash course, a high-intensity learning environment.
Okay, so the appeal is strong, the basic idea is clear, potential benefits are significant, but let's get back to that core question we need the data for. Is it still profitable, in today's specific market?
Right. This is where the numbers really have to guide us. And what we see is, while flipping activity has decreased from that kind of frenetic pace we saw during the pandemic peak, like 2022.
Yeah, things were crazy then.
They were. But the detailed reports we've looked at, they make it clear that strategic investors are still finding profitable opportunities. It's definitely not as easy as it was, maybe.
But it's possible.
Absolutely still possible for those who approach it with, real discipline.
Okay, so the opportunity is there. What do the actual numbers, the specifics from the sources tell us about how profitable it is?
Okay, let's dig into those key stats. Now, the sources cite slightly different figures, depends on the market and the exact time period they looked at, but average gross profit per flip in favorable markets recently. It's been ranging somewhere between, say, $40,836 on the lower end in some analyses, up to around $70,000. Okay. Looking at the most recent quarterly data we have, like Q3 2024, the average gross profit per flip was reported right around $70,250.
$70,000.
Which was actually slightly down from Q2 2024, where it was about $73,500.
Okay, 70 grand on average per deal? That's still, that's a substantial amount of money.
It is. But tracking the trend gives us really important context.
Right. How has it changed?
Well, the average gross profit for all of 2023 was about $66,000. And that was specifically noted as being lower than the average in 2022, which was closer to $70,100. So
it dipped in 23.
It did. But then, interestingly, we saw an increase in Q1 of 2024, bounced back up to $72,375, which was up from about $65,000 in Q4 of 2023. So a bit of a recovery there. But, and this is important, it's still below that peak average we saw in 2022, which was closer to $80,000.
So profits dipped, recovered a bit, but haven't quite gotten back to those peak levels.
Exactly. That fluctuation tells you something about the market conditions.
Okay. What about the ROI, the return on investment? Because like you said, 70 grand profit sounds great, but if you had to put in a huge amount of capital...
Exactly. ROI is arguably the more critical metric, right? Because it tells you the percentage return relative to the money you actually invested.
So what are those numbers looking like?
Recent figures show the average ROI for flippers was about 28.7% in Q3 2024. And it was slightly higher in Q2 2024 at 30.4%.
Okay, around 30%.
For the full year 2023, the average was 27.5%.
27.5%. Now, how does that trend compare to the past? Is that good, bad, average?
This is key. The average ROI has seen a pretty significant decline from its peak. Way back in 2016, the average ROI was, get this, 49.2%.
Wow, nearly 50%.
Yeah. So that 2023 ROI of 27.5%, that was actually the lowest recorded average since way back in 2007.
Lowest since 2007. That's a long time.
It is. One source pointed out that profit margins, which are essentially ROI, had declined for 6 out of the 7 years leading up to 2024.
6 out of 7 years.
Although they did see that little bump up in Q1 2024 we mentioned. Still, even with that bump, they remain about 25 percentage points below those 2016 highs.
Wow. Okay, so the takeaway there is the raw dollar profit might still look tempting sometimes, but the actual percentage return you're getting on your invested money is, on average, much lower than it was, say, 8 years ago.
Absolutely. That fundamentally changes the math on whether a deal makes sense.
Yeah, it means you have to be even more careful with your costs, right? And the purchase price to make the numbers work.
Precisely. But even with this, let's call it compressed ROI compared to the past. The sources still highlight something interesting. House flipping is still cited as the most profitable exit strategy for investors compared to other methods.
Like wholesaling.
Exactly. Like wholesaling. One report indicated flipping delivered over $11,000 more in average profit per deal in 2024 than wholesaling did.
Okay, so it's still potentially the most lucrative strategy, even if the margins are thinner overall?
Potentially, yes. Right. And some statistics point to the average active flipper, someone doing this consistently, earning around 6 figures annually. specifically like $117,372 per year.
Which suggests they're doing multiple deals or maybe larger, more profitable projects.
Right. It implies that doing multiple flips or tackling bigger projects can still build up to a significant annual income for those who are successful at it.
Okay, so profitability is possible. Margins are definitely tighter than they were. What about the overall activity? Like, how much flipping is actually happening? Is it still a big part of the market?
Yeah, the data on market volume gives us important context here. So flipping's share of all home sales, that peaked back in Q1 2022 at 10%.
1 in 10 homes sold was a flip back then.
Pretty much, yeah. Since then, it's moderated quite a bit. It accounted for about 7.2% of all home sales in Q3 2024. And it was a bit higher in Q1 2024 at 8.7%.
Okay, so down from the peak, maybe around 7-8% now. Still, that represents a pretty notable slice of the overall housing market activity.
It does, and looking at the total number of flips gives us a sense of the scale. In 2022, at the peak, there were about 407,417 properties flipped.
Wow! Nearly 500,000.
Yeah. But then this number saw a really significant drop in 2023, down to 308,922.
It's a big decrease.
Huge. It's a 29.3% decrease year over year. That was the largest annual drop recorded since, you guessed it, 2008.
Oof. Okay.
Yeah. Looking quarterly, there were about 74,618 flips in Q3 2024, which was actually down about 5% from Q2 2024. So after that sharp decline in 2023, the volume seemed to be maybe stabilizing somewhat, albeit with some recent softening quarter to quarter.
And you mentioned regional differences earlier when we talked about ROI. Does the volume of flipping also vary a lot by location?
Oh, absolutely. The reports noted that flipping rates, that percentage of sales, actually decreased in about 64% of individual local markets they analyzed recently, so slowing down in many places.
Right.
However, looking specifically at metro areas, the flipping rate actually increased from Q4 2023 to Q1 2024 in a significant majority of them. Like 77.5% of the 173 metro areas studied saw an uptick in activity during that period.
Huh. That's interesting. So activity might be slowing in some smaller markets, but picking up or consolidating in larger metro areas.
It seems that way. And over 31% of the counties analyzed had flipping rates above 10% in Q1 2024. That was up from about 22.7% in Q4 2023.
So even though the overall number of flips dropped significantly from that 2022 peak, it sounds like activity might be concentrating or even heating up again in specific areas more recently in 2024.
That's what it points to. It suggests investors are maybe becoming more selective, right?
Yeah.
Concentrating their efforts where they see the best opportunities rather than just flipping anywhere and everywhere like might have happened during the absolute peak frenzy.
Right, riding the wave isn't enough anymore.
Exactly. So the data picture is this. Profits are still achievable, but often with tighter margins than before. Volume is down from the peak, but seems to be concentrating in certain areas, maybe showing some recent strength there. And the market clearly demands a much more strategic approach than just relying on general appreciation to make money.
Okay, so that data gives us the landscape. Profits possible, volume shifted, margins tighter. But, and this is a big but, the sources make crystal clear that potential for profit comes hand in hand with some really substantial risks.
Huge risks.
Let's shift gears now and really unpack those pitfalls, because this is where that glamorous TV picture can just dissolve into serious financial trouble if you're not prepared.
Absolutely. Navigating these risks successfully is, well, it's non-negotiable for success in today's market. The sources highlight several key categories of risk that flippers just have to actively manage.
And right at the top of that list, it seems, is financial risk, primarily driven by underestimating the costs. Sounds like the most common trap.
It absolutely is. And it's probably the quickest way to turn a potential winner into a definite loser. It's so easy, right? You walk through a house, you make a quick mental list. Oh, paint new floors, maybe update the kitchen.
Yeah, you ballpark it.
You ballpark it. But the sources just emphasize over and over the need for a meticulous, super detailed financial analysis covering all the costs, not just the obvious ones.
So what does all costs really include?
Okay, so obviously the purchase price, that's number one. But then the full itemized renovation budget, materials, labor, permits, which can sometimes be surprisingly expensive and time-consuming.
Okay.
Then you have the significant holding costs. These are the expenses that just keep ticking up every single day you own that property until it sells.
Like what?
Mortgage payments, if you financed it,
Well,
property taxes, homeowners insurance, utilities, water, electric, gas,
yeah.
maybe HOA fees if it's in a community.
Right. Those add up fast.
They really do. And then you have the selling costs at the end. Real estate agent commissions usually the biggest chunk. closing costs that the seller often pays, maybe even concessions you have to give the buyer to close the deal. It all adds up.
And the real killer here, the thing that just blows budgets apart, seems to be those unexpected repairs you mentioned earlier.
Precisely. This is like the boogeyman of flipping, right? You might have budgeted perfectly for new flooring, but oops, when you pull up that old carpet.
Surprise.
Surprise! Extensive dry rot in the subfloor from some old leak you had no idea about. Or you open up a wall to update a bathroom and bam, all the plumbing behind the tiles is corroded and needs replacing. A much bigger job than planned.
Or worse, like electrical needing a full rewire or foundation issues.
Exactly. Those are the major ones. Things you often can't see on a walkthrough. They can easily add tens of thousands, sometimes, believe it or not, even hundreds of thousands, to a renovation budget you thought was solid.
And that's where those holding costs become like a double whammy, right? Because the unexpected repair takes longer to fix.
Exactly. Which means more months you're paying taxes, insurance, utilities, mortgage.
Eating away at any potential profit.
Completely. Time delays directly amplify that financial risk through those increased holding costs. So the sources are very clear on how you mitigate this. Number one, rigorous planning and budgeting. Non-negotiable. Meaning you must include a contingency fund in your budget. An extra for unexpected repairs line item. Don't think of it as optional padding. Think of it as a required cost.
Okay, build in a buffer.
Build in a buffer. You absolutely need to perform a thorough deal analysis before you buy. Compare your estimated after repair value, or ARV, what you realistically think the house will sell for after it's fixed up.
Okay.
Compare that ARV against all your anticipated costs, purchase price, rehab budget, holding costs, selling costs, including your contingency buffer. Does the math still work?
Due diligence before you commit.
Absolutely critical. Getting thorough professional home inspections done before you buy is paramount. Don't skip this to save a few $100. It could save you thousands.
Makes sense.
And building a team of reliable contractors who can give you accurate, detailed estimates based on a clear scope of work that's essential for budgeting effectively from the start.
Okay, so meticulous financial planning, thorough inspections, contingency funds, those are the shields against financial risk. What's the next major pitfall the sources highlight?
Market risk. This is the unpredictability factor. You buy a property based on today's market conditions, you look at recent comparable sales, comps, and you project it'll sell for X amount once you fix it up.
But the market doesn't always cooperate.
Exactly. Markets can shift. Interest rates might jump up again, cooling down buyer demand. The local economy could take a hit, layoffs happen, or even if the overall market stays generally strong, maybe your specific property just doesn't sell as quickly as you planned.
And then you're back to those holding costs eating into your profit again.
Precisely. It all ties together. This ties into choosing the right location, which we'll definitely talk more about, but it's also about timing, isn't it?
Yeah.
Understanding the local market isn't just about looking at recent comps, what they sold for, what kind of finishes they had. The sources really emphasize analyzing those microeconomic factors specific to that metro area or even that neighborhood.
Like what kind of factors?
You need to look at job growth. Are companies moving in or out? Because jobs attract people and people need housing. Look at rental rates. High rents can sometimes indicate strong underlying demand for housing in general.
Okay.
Consider median home prices relative to local incomes. Is the area still affordable for typical buyers? Look at new construction starts or developers building a lot, potentially increasing future supply and competition. It's really about understanding the fundamental supply and demand dynamics in that specific place.
So just flipping near where you live because it's convenient might actually be a big market risk if your local area doesn't have strong fundamentals.
It absolutely could be. The sources suggest looking for markets based on opportunity, not just proximity. Look for characteristics that support demand and property values. Low crime rates, good schools, nearby amenities like restaurants, parks, gyms, things that make a neighborhood desirable for potential buyers.
That makes a lot of sense. You're not just buying a structure, you're buying into a local ecosystem that has to support its value. Okay, what about time risk? You mentioned how it connects to holding costs.
Yeah, time is perhaps the most direct cost factor in flipping right after the actual renovation budget. Every single day the project drags on, or every day the finished property sits on the market unsold.
Could cost you money.
It costs you money through those holding costs. So the core problem here is delays. Renovation projects are complex beasts, right? They often face unforeseen issues, maybe permitting delays from the city government. Maybe your key contractor gets sick or gets held up on another job. Maybe essential materials like windows or appliances are back-ordered.
Happens all the time.
All the time. And any delay, big or small, directly impacts your timeline and therefore your bottom line.
Did the sources give any indication of the typical time it takes to complete a flip these days?
Yeah, the average time from purchase to sale was hovering around 166 days in 2024, according to one report.
166 days. So what's that, like 5.5 months?
Roughly, yeah. Interestingly, that was down slightly from 178 days in 2023, but still up from 2021 and 2022 when things were moving maybe a bit faster in the hotter market. Some areas are quicker, like Colorado averaged about 147 days in one analysis.
Okay, so you're generally looking at roughly 5 to 6 months on average, if you budget for 3 months and it takes 6.
Ouch. Those extra 3 months of holding costs can just wipe out a huge chunk of your potential profit.
So how do you mitigate that time risk? Is it just about pushing contractors to work faster?
Well, that's part of managing it, but the sources caution against just rushing the work.
Yeah.
Poor quality workmanship is going to hurt your resale value, right?
Yeah.
It could lead to buyer complaints after closing or even future legal headaches.
Right. Don't sacrifice quality for speed.
Exactly. Mitigation really involves careful, realistic scheduling from the outset, with buffer time built in for those inevitable small delays. It means staying on top of your contractors, communicating clearly and often, and proactively addressing potential holdups before they become big problems.
And sticking to the plan.
Yeah, sticking rigorously to your initial renovation plan and budget helps a lot too. Scope creep, deciding mid-project, let's add this extra fancy feature that often causes both budget overruns and significant time delays.
Good point. Okay, and that brings us nicely to the contractor risk itself. You're relying heavily on other people to do the actual physical work, and that seems like it opens up a whole new set of potential problems.
It absolutely does. While having a good team is essential if you want to scale up and do multiple flips, outsourcing the work inherently comes with risks. Contractors might not finish the job, their work quality might be poor, they might manage their budget poorly and come back asking for more money, or they just don't stick to the agreed-upon timeline.
Finding and managing good, reliable contractors sounds like one of the biggest challenges.
It really is, consistently cited as a major hurdle in flipping.
So how do the sources suggest mitigating that risk?
Well, the number one thing is building a trusted network of reliable contractors over time. This isn't easy. It takes effort, networking, asking for referrals, and probably some trial and error. You need people who are not only skilled, but also reliable communicators and professionals.
And once you have them,
maintain open and frequent communication lines during the project. Don't just hand them the keys and check back in a month. Regular check-ins, site visits, quick phone calls, they help you catch issues early, address questions quickly, and just keep everyone aligned and on track. And of course, having clear, detailed contracts outlining the exact scope of work, the payment schedule tied to milestones, and the expected timeline is also absolutely essential.
Phew, okay. When you lay out all those risks, the financial, the market, the time, the contractor risks, it really underscores that this is a serious business undertaking. It's definitely not a get-rich-quick scheme like some TV shows might make it seem.
Not at all. It absolutely highlights that successful flipping, especially in today's market, isn't just about finding a good deal, though that's important. It's much more about disciplined execution and rigorous risk management across the board.
Right. The sources really stress that success now hinges less on just getting lucky with market appreciation.
Much less.
And much more on having a solid, repeatable process and the right team in place to execute it well.
Exactly. You know that saying in the flipping world, the money's made on the buy, meaning getting a good purchase price is critical.
Yeah, I've heard that.
Well, that's true. It's definitely important. But even if you get a fantastic buy, the sources suggest that ultimate success often comes down to how well you execute the renovation plan, manage the project effectively, and control all those costs we just talked about. Having the right resources, particularly skilled people like good contractors and vendors, is absolutely critical for that effective execution.
Okay. And central to that effective execution and also mitigating that huge financial risk seems to be having a truly deep, almost granular understanding of your costs.
Bingo. One of the single biggest mistakes new flippers make, according to pretty much all the sources, is simply guessing what the renovation is going to cost, or using some vague rule of thumb. You need clarity. You need accuracy.
So how did the successful, experienced flippers achieve that kind of cost clarity? What's the process?
The sources offer several really practical steps. First, they say you need to build a framework or a checklist for your rehab process. Don't treat it as optional. It's a system to make sure you don't overlook anything, and it provides structure to your planning.
Like a standard operating procedure for renos.
Kind of, yeah. And part of that is creating a super detailed scope of work. This isn't just remodel kitchen. It's a comprehensive list of every single task that needs to be done. Major stuff like HVAC replacement or roofing, right down to the small cosmetic details like specific light fixtures, paint colors, hardware, everything.
And you use this detailed list when?
You use this scope of work document during your walkthroughs of potential properties before you even buy. It helps you systematically assess what needs doing.
Okay, so you have this incredibly detailed list of exactly what needs to be done. How do you then get accurate cost estimates for all those tasks?
This takes effort, especially when you're starting out and don't have a history to draw on. One key tip is when you bring contractors through a property to give you bids, don't just describe what you want, show them. Bring photos of comparable renovated houses, the comps.
So they see the level of finish you expect.
Exactly. So they understand the level of finish and quality you're aiming for. Don't just say, update the bathroom. Show them a photo of a bathroom with a kind of tile vanity fixtures that represent your vision. It reduces ambiguity.
Good tip.
And crucially, get multiple bids for the exact same detailed scope of work. The sources consistently recommend getting at least 3 bids for each major bits. Treat your plumber, electrician, HVAC tech, your general contractor if you use one, etc.
And getting multiple bids helps you avoid getting overcharged, right? And gives you a sense of the fair market rate for that work in your area.
Precisely. It does both. And then here's the next step for experienced flippers. Over time, you should be building your own cost database or spreadsheet based on all these historical bids you've collected and the actual costs you incurred on past projects.
Tracking everything meticulously.
Meticulously. Track what different tasks actually cost you in different properties in your market. Calculate your own average cost, maybe per item, like the cost to install a new toilet, or per square foot, like your typical painting cost per square foot, or even average costs for standard room renovations, like your average cost for a small bathroom gut job or a medium kitchen remodel.
So you build your own internal pricing guide.
Exactly. Once you have this historical data specific to your market and your standards, you can look at a new potential property, plug in its specific square footage, number of bathrooms, specific issues you identified using your scope of work, and generate a highly accurate estimated budget based on your own real-world experience.
That sounds powerful. How accurate can that get?
Well, one experienced flipper mentioned in the sources claimed that using this kind of detailed historical cost database allows them to predict their final rehab costs with almost 98% accuracy.
98%? Wow, that's incredible. That level of precision must come from just relentless tracking and repetition over many deals.
It absolutely does. And the cool thing is you can start building this knowledge base before you even buy your first flip.
Wow.
Practice. Find properties currently listed for sale in your target market that look like potential flips. Call the listing agent, explain you're an investor doing research and building your cost knowledge, and ask if it's okay to bring a contractor through to get a practice bid. Do this on several different types of properties.
That's a great way to learn without having skin in the game yet.
Invaluable exercise. And whatever you do, the sources plead. Don't waive a home inspection contingency, especially early on, without truly understanding the potential costs you might be taking on. One investor shared a cautionary tale.
Oh, yeah.
Lost significant money on a deal. The purchase price looked good, the quick estimate seemed fine, but they waived the inspection to be competitive. After closing, they found major structural issues, completely unknown.
And those costs just killed the deal.
Killed the profit entirely. Harsh lesson, but really important. Know your costs before you own it.
Definitely. Okay, so mastering costs is huge. Beyond contractors, what other key team members do the sources say are crucial for success?
Finding a truly investor-friendly real estate agent is key. This isn't just any agent who sells houses.
What makes them investor-friendly?
They get it. They understand investors' goals. They speak the language, ARV, rehab cost, ROI, cap rates. They can actively help you find deals that fit your specific criteria, maybe even off-market deals sometimes. And crucially, they can help you analyze whether the numbers on a potential deal actually work from an investment perspective.
So they're more like a strategic partner than just someone opening doors.
Exactly. The sources specifically recommend seeking out targeted brokers or agents who really focus on working with investors. They often have better access to foreclosures, probate sales, tired landlord listings, the kind of properties flippers look for.
And they're motivated to help you succeed long term, right?
Yeah.
Because they want your repeat business on future flips.
Precisely. It's a symbiotic relationship when it works well.
Okay. And how are these projects typically funded? Financing is obviously a massive piece of this puzzle, especially with tighter margins.
Yeah, financing is critical. And the data in the sources shows that, interestingly, cash is still king in the flipping world.
Really? Still?
Yeah. In Q1 2024, for example, a pretty significant majority, 63.8% of flipped homes were purchased by investors using all cash.
Wow, almost 2/3. That suggests having access to significant capital is a big advantage.
It definitely is. However, the percentage of flips bought with financing has seen a slight increase recently. It was at 36.2% in Q1 2024.
So about a third are financed.
Right. Although it's worth noting that percentage is still down compared to earlier years. Like back in 2017, it was closer to 43% financed.
Okay. And for those who do finance, what's the most common method? Are they getting regular mortgages?
Not usually for the purchase and rehab, no. The most common financing method mentioned for flips, particularly for investors who don't have all the cash up front, is using hard money loans.
Hard money. I've heard that term. What is it exactly?
They're basically short-term loans, usually from private lenders or companies rather than traditional banks. They're secured by the property itself, the hard asset. They can often be funded much faster than traditional mortgages, which is important in competitive buying situations.
Okay, sounds convenient. What's the catch?
The catch is the cost. Hard money loans typically come with significantly higher interest rates than conventional mortgages. One source mentioned rates being in the range of 9% to maybe even 15% back in 2023. Plus, they often have higher upfront fees or points.
Ouch, 9 to 15% interest. That can really chew into a profit margin, especially if you face delays and the holding period gets longer.
It absolutely does. Every month you're paying that high interest rate directly reduces your bottom line. And finding affordable capital is explicitly identified in the sources as one of the major challenges flippers are facing in the current market environment. Securing cost-effective financing, whether it's hard money, private loans, lines of credit, or something else, is a really critical part of making the whole deal profitable.
Okay, this is incredibly helpful. We've really drilled down into the numbers, the significant risks, the importance of cost control, building the right team, and the financing aspect. But as the data you shared earlier hinted, and the sources make abundantly clear, success in flipping is absolutely not uniform across the country. Location, location, location. It's maybe more critical than ever.
Oh, absolutely. This is where the regional data from the sources just becomes incredibly compelling, almost dramatic. It highlights these massive differences in average profitability and ROI, and even in risk levels, depending entirely on the state or the specific metro area you're looking at.
The difference between the best and worst markets is really that stark.
It's incredibly stark. Mind-blowing almost.
Okay, give us some examples. Let's hear the highs and lows.
All right, let's look at state-level ROIs from Q2 2024 data. Pennsylvania was leading the entire nation with an average ROI of 80.2%.
80% ROI statewide. Wow.
Yeah, pretty amazing. Though even that was down a bit from over 90% the year before. Only Maryland and Illinois were also seeing average ROIs over 60% in that quarter. Now, contrast that with the other end of the spectrum. Montana had the lowest statewide ROI reported in Q3 2024 at, wait for it, 0.8%.
0.8%.
Yep, which translated to an average gross profit of just $3,734 per flip in the entire state. And interestingly, 6 out of the 10 worst markets by ROI in Q3 2024 were all located in Texas.
Wow. Okay, the difference between an 80% average ROI in one state and less than 1% in another. That's just unbelievable. It completely changes the viability of the strategy depending on where you are.
It really, really does. And looking at specific metro areas gives you even more granular, sometimes even more extreme examples.
Okay, let's hear some. Where were the hot spots?
Well, Ocala, Florida topped the charts in Q3 2024 with a remarkable 141.5% average ROI.
141%.
Yeah. And Pennsylvania metros were just dominating the list of top performers in Q1 2024 data. Pittsburgh was at 120.6% ROI. Reading, PA was 124.9%. Scranton hit 115.7%. Harrisburg, 113.6%. Buffalo, New York also showed up really high, 127.8% average ROI.
Those are just incredible returns in those specific places. Makes you want to pack your bags. But where were the tough spots? The low-performing metros?
Equally important to know, right? The low-performing list tells a cautionary tale. Boise City, Idaho, for example, had a very low average ROI of just 1.8% in Q1 2024. And that followed an even lower 0.8% reported in early 2023. So consistently tough there.
Less than 2% ROI.
Yeah. Looking at major metro areas, those with over 1 million people in Q1 2024. Austin, Texas stood out with an average ROI of just 0.3%. Basically break even on average.
0.3% in Austin. Wow.
Urban Honolulu, Hawaii was at 1.7%. San Antonio, Texas, around 2%. And the reports also highlighted some markets like Jackson, Mississippi, and Killeen, Texas, where the average flip was actually selling at a loss or just barely breaking even during certain periods.
So literally, you could potentially make tens, maybe hundreds of thousands in profit per flip in one market. Or you could realistically expect to lose money or make next to nothing in another market based purely on location.
That's exactly what the data shows. Yeah. It's that dramatic. And it's also important, as you hinted before, to understand the difference between high raw dollar profit and high ROI.
Right. Explain that difference again.
So some markets, usually very expensive coastal areas, might show huge average dollar profits per flip simply because the home prices are so high. For example, San Jose, California saw an average gross profit of like $297,500 in Q3 2024.
Yeah.
Sounds amazing, right?
Yeah.
But that was on an average resale price of $1.6 million. So while the dollar amount is huge, the actual percentage return on the investment, the ROI, might not be as high percentage-wise as a flip in, say, Pittsburgh, where the dollar profit might be smaller, but the percentage gain relative to the lower purchase price is much higher.
Got it. So high prices mean big dollar swings, but ROI tells you efficiency.
Exactly. And conversely, those markets with minimal raw profit or even average losses like we saw in some Texas cities or Jackson, EmmaScript, they show just how incredibly difficult it can be to make the numbers work at all when the combination of purchase price, rehab costs, and what the market will actually bear for the finished product just doesn't line up favorably.
And does the volume of flipping, like the activity level, also correlate with this performance? Are the high ROI places also the busiest?
Generally, yes. There's often a correlation, but not always perfectly. Activity levels definitely vary regionally, too. Some areas have very high flipping rates, meaning flips make up a larger percentage of their total home sales. Like Warner Robins, Georgia, was reportedly at 18.7% in Q1 2024.
Nearly 1 in 5 sales was a flip there.
Yeah. Other Georgia metros like Macon and Atlanta also consistently show high flipping activity. This usually suggests a more active, maybe more established investor community finding opportunity.
And the low activity areas.
On the other hand, places like urban Honolulu, Hawaii, and Seattle, Washington consistently have some of the lowest flipping rates in the country, often below 6%, sometimes even lower. This could indicate that the market dynamics there may be very high entry costs, strong competition, less distressed inventory, are just less favorable for the typical quick-turn flip model.
Okay. So, pulling all this regional data together, what's the absolute critical takeaway for someone listening who's thinking about flipping?
The overwhelming, unavoidable message is this. Meticulous, location-specific market research is not just a good idea, it's absolutely fundamental to your chances of success. The old idea that you can just flip houses anywhere you happen to live, or anywhere that looks nice, is simply not supported by the data anymore, if it ever was.
So investing close to home just for convenience could be a huge mistake.
It could be a recipe for disaster if your local market happens to be one of those low ROI or high-risk areas we just discussed. You are significantly increasing your odds of failure if you don't verify the numbers in that specific location. You need to understand the local economic fundamentals, yes, but also the actual historical flipping performance metrics, average ROIs, average days on market, typical rehab costs for the specific area you're considering.
Which might mean looking beyond your own backyard.
It absolutely might mean looking at markets an hour or two away, or potentially even in another state. If the data shows the numbers and trends are significantly more favorable there, you have to follow the opportunity, not just convenience.
That's a really critical point. Your perfect flipping market might not be where you currently live. Okay, so let's assume you've done that research. You've found the right market. You've sourced a good deal, navigated the purchase, managed the renovation meticulously, kept those costs under control. There's still one final crucial hurdle before you actually bank that profit, right?
Absolutely. The sale. Selling the flip.
You've got to sell it. And sell it quickly, ideally, and for the best possible price to capture all that potential profit you worked so hard for.
Exactly. This is where the quality of your execution throughout the process really shines through, or where it falls short. Your disposition strategy, how you handle the sale, becomes paramount. Successful flippers, the ones who do this consistently, understand they are building a reputation. They're delivering a finished product to a retail home buyer.
And you want that buyer to feel good about it.
You want that buyer to walk into your renovated house and feel confident, comfortable, like they're buying a quality home, not something where corners were cut just to make a quick buck.
Yeah.
You really want to avoid that negative stereotype of the slap-together flip. That's key for a smooth sale.
Okay. So how do the sources suggest you ensure that smooth and successful sale process after all the hard work of the renovation? What are the tips?
Several really practical, valuable tips came up in the sources. First, and this is something the really savvy flippers often do, get a pre-inspection done before you even list the house for sale.
A pre-inspection, meaning you hire an inspector yourself.
Exactly. Hire your own professional home inspector to go through the renovated property, just like a buyer's inspector eventually will. Why? Because it helps you uncover any potential issues that you might have missed during the renovation, or maybe something your contractors overlooked, or just things that a buyer's inspector is likely to flag anyway.
Ah, so you find the problems before the buyer does.
Precisely. Knowing about them up front gives you options. You can either fix them proactively before you list, making the house truly move-in ready, or, if they're relatively minor things, you can choose to disclose them openly right from the start.
How does that help?
It builds tremendous trust with potential buyers. It shows you're transparent, you stand behind the quality of your work, and you're not trying to hide anything. In a market where buyers might be naturally wary of flips, that level of transparency can make a huge difference.
That's a really great point. Proactive transparency. What else?
Second, create a detailed punch list during your final walkthrough right before the property officially goes on the market.
A punch list.
Yeah, this is where you go through the house with a fine-tooth comb, meticulously.
Okay.
Often people use blue painter's tape, hence the term blue taping, sometimes to mark any tiny imperfection you see. A spot that needs a paint touch-up, a cabinet pull that's slightly loose, a bit of grout that needs cleaning, a scuff on the floor. Anything.
Okay, super detailed.
Super detailed. Take photos of everything on the list, give that clear, itemized list to your contractor or handyman. And this is critical, verify that every single item has been completed correctly before you put up that for sale sign. This ensures the house is absolutely polished and truly move-in, ready for the buyer.
That attention to detail right at the very end must make a big difference in perception.
It's crucial for making that great first impression. Third tip, staging. Consider staging the house, especially if it's in a competitive market or if it's a higher-end flip where buyers expect a certain lifestyle presentation.
Does staging really make that much difference?
Professional staging can make a huge difference. It helps buyers mentally move in, envision themselves living in the space. It makes the home feel warmer, more inviting, and it can really maximize the perceived use and flow of each room. It's particularly effective, the sources say, for homes that might have slightly awkward layouts or smaller rooms, because good staging demonstrates how furniture can fit and how the space can actually function well. It helps buyers overcome potential objections and make that crucial emotional connection.
Helps them see it as their potential home, not just a vacant house.
Exactly. And then finally, a simple but important one. Maintain the property constantly while it's listed. Don't let things slide once the renovation is done.
Like curb appeal.
Definitely curb appeal. That's the absolute first impression. Keep the lawn mowed, the bushes trimmed, the entryway clean and inviting. Inside, ensure it's kept spotless for every showing. If the house is vacant, you or someone needs to check on it regularly, run the water, check for issues, keep it fresh. Don't let all your hard renovation work be undermined by simple neglect during that critical selling phase.
Those are all excellent practical steps to maximize your chances of a quick, profitable sale at the end. Okay, let's pull back for just a moment and look at house flipping within the sort of wider investment universe. How does the potential return we talked about earlier stack up against more traditional ways people invest their money?
Yeah, the sources offer this comparison, which is useful context. That national average ROI for house flipping, which we said was recently hovering around, 28, 31%?
Yeah, somewhere in that range.
Well, that compares quite favorably, at least on paper, to the historical average annual return of something like the S&P 500 stock market index, which is typically cited as being around 10% per year before adjusting for inflation, maybe closer to 6-7% after inflation over the long term.
Okay, so percentage-wise, flipping can offer significantly higher potential returns in a single year than just passively investing in the stock market over the long run.
It can, but, and this is a massive flashing lights caveat, it comes with a fundamentally different risk profile and a vastly different level of required effort.
Right. It's not passive at all.
Not even close. Flipping is a highly active investment strategy. It requires significant amounts of your time, specialized skills, constant management, and dealing with all those risks we detailed. Investing in a broad stock market index fund, on the other hand, is generally passive. You buy it, you hold it.
And the risk difference.
Huge difference. The sources highlight the stark reality of flipping risk. In 2023, there was a reported 22% failure rate for flips.
22%? What does failure mean in this context?
It means that roughly 1 out of every 5 flips initiated that year sold at break-even or, even worse, at a loss.
1 in 5 lost money or made nothing.
That's what the data suggested for 2023. That's a very, very high failure rate compared to, say, the probability of actually losing money over a reasonably long holding period in a diversified stock index fund. Flipping is absolutely high risk, potentially high reward, but definitely high effort.
That 22% failure rate really drives home the point that this is absolutely not a guaranteed win, even if you do everything right. Okay, what about the current overall housing market conditions? We're talking 2024, looking into 2025. How do things like the still high home prices, the elevated interest rates, the inventory levels, how do those broader factors affect the flipping business right now?
Yeah, the current market conditions definitely create a challenging backdrop, no question. The primary issue centers around affordability for the end buyer, the person you need to sell your finished flip to.
Because prices are still high?
Prices are still persistently high. While the pace of price growth, of appreciation, has slowed down considerably from the frenzy, we haven't seen significant widespread price drops in most markets. Combine those high prices with mortgage rates that are still significantly elevated compared to a few years ago.
And it just crushes buyer purchasing power.
It really does. It significantly impacts how much house a typical buyer can afford. So this means that even if you create a beautifully renovated house, the pool of potential buyers who can actually qualify for a mortgage and afford your target sale price might be smaller than it was when rates were lower. That can make it harder to sell quickly and maybe harder to get top dollar.
So the market for your finished product is potentially tighter. What about the supply side? Inventory.
Inventory levels are also still well below historical averages in most parts of the country. There just aren't as many houses listed for sale as there typically would be.
Why is that still the case?
A big part of the reason is the lock-in effect we hear so much about. So many current homeowners refinanced or bought when mortgage rates were at historic lows, like 3% or even less. They're now very reluctant to sell their current home and give up that super low rate, only to have to take out a new mortgage on their next home at today's much higher rates, maybe 6 or 7% or more.
That would be a huge increase in their monthly payment, even for the same priced house.
Exactly. So that keeps many potential sellers on the sidelines, which keeps the overall supply of houses for sale low. Now, in some ways, low inventory can help flippers by reducing the competition they face when they go to sell their finished product. But it also means fewer potential distressed properties or homes needing significant work are coming onto the market for flippers to buy in the first place. The supply of potential deals might be tighter too.
Makes sense. What about new construction? Isn't that supposed to help with supply?
It does help, but new construction is also facing its own challenges. Builders are dealing with higher financing costs themselves, labor shortages in some areas, and sometimes volatile material costs, which can be affected by things like tariffs on imported goods. So while new construction is adding inventory, it's maybe not happening at a pace that dramatically changes the overall supply picture quickly.
Okay. What about foreclosures? That's often seen as a source of deals for flippers. Are we seeing a big surge in foreclosures given the economic pressures and higher rates that might create more opportunities to buy low?
That's a really common question, especially for people who remember the aftermath of the 2008 crisis. However, the current data, according to the sources we looked at, does not indicate that a widespread foreclosure surge, like a tidal wave washing over the market, is happening or is even on the immediate horizon.
Really? Even with affordability challenges?
Even with those challenges. Now, foreclosure starts, the initial filings have seen some recent quarterly increases. One report noted they were up maybe 14% quarter over quarter and 2% year over year in early 2025. So there's an uptick.
Okay, so it is increasing.
Yes, but, and this is the crucial context, those levels remain significantly below historical norms. Critically, the sources emphasize they are still about 35% below the level seen just before the pandemic in 2019, We are nowhere near the level seen during the last crisis.
Okay, so why isn't the current economic pressure, the higher rates, translating into a flood of foreclosures like we saw back then? What's different this time?
The key difference, highlighted repeatedly by the sources, is the absolutely immense amount of homeowner equity that was built up over the past decade, especially during that rapid home price appreciation cycle we saw recently.
People have a lot more equity in their homes now.
A ton more. Total homeowner equity in the U.S. is staggering, estimated at over $34.7 trillion.
Yeah.
And get this, more than 47%, nearly half of all mortgaged homes in the U.S. are considered equity rich.
What does equity rich mean exactly?
It typically means the outstanding mortgage balance on the home is 50% or less of the home's estimated market value. So they have at least 50% equity built up.
Wow, nearly half of homeowners with mortgages have that much equity.
Yeah, and this high level of equity acts as a massive buffer against foreclosure. If a homeowner faces financial distress today, maybe they lose their job or face unexpected expenses, they typically have enough equity cushion in their home to sell it on the open market, pay off the mortgage completely, cover all the selling costs, and still walk away with cash in their pocket. They can avoid foreclosure entirely by selling proactively.
Or maybe they can use that equity.
Exactly. They might be able to leverage that equity through a cash-out refinance, though less common now with higher rates, or a home equity loan or line of credit, HELOC, to cover missed payments, pay down other debts, and get back on track financially. So because of this huge equity buffer, the path to foreclosure is much less likely for most distressed homeowners today compared to 2008 when many people had little or no equity.
That makes a lot of sense. So based on the current data and those high equity levels, a widespread foreclosure crisis that would suddenly flood the market with deeply discounted properties for flippers just isn't predicted right now.
That's the consensus from the sources, yes. It doesn't mean no foreclosures are happening or that deals can't be found, but it means that finding those discounted properties likely requires more proactive effort, better networking, and smarter sourcing strategies than simply waiting for a foreclosure wave that the data suggests isn't coming in the near future.
That's really crucial context for anyone banking on finding easy, cheap deals that way. It reinforces what you said earlier. Successful flipping today seems much more about smart sourcing, really rigorous analysis and diligent execution, rather than just relying on some external market event like a foreclosure flood to hand you opportunities.
Precisely. The game has changed, or at least the easy mode might be over.
Okay, wow. We have covered a tremendous amount of ground in this deep dive, really getting into the weeds of house flipping in the U.S. market right now in 2024 and looking ahead into 2025.
We really have, and the picture that emerges is, well, it's complex, isn't it? We've seen the data confirms, yes, it's still possible to achieve significant profits. People are doing it. But it's also equally clear that it's a much more demanding, much more nuanced endeavor than maybe those TV portrayals let on.
Definitely not as easy as it looks on TV.
Not at all.
Yes.
Certainly not as universally easy or perhaps lucrative as it might have felt during that absolute peak market frenzy a couple of years ago when, frankly, rapid price appreciation could sometimes bail out mistakes in budgeting or execution.
Right. A rising tide lifted all boats then, even leaky ones.
Exactly. Success today seems to hinge much less on just riding that general market momentum and far more on having a disciplined strategy, doing rigorous upfront analysis, maintaining tight cost control throughout the renovation, ensuring careful execution of the actual work, and making really smart data-driven decisions about where to invest your capital.
Okay. So if you're listening to this and seriously considering this path, let's try to boil down some of the absolute key takeaways from our dive today.
Good idea. Let's recap. First, the potential profits are definitely real for many investors who get it right. But the average return on investment, that ROI, is notably lower now than it was just a few years ago during the peak.
Yeah.
And the risks of failure, meaning selling at break even or worse, taking a loss, are significant. Remember that figure, roughly 1 in 5 flips in 2023 fell into that category according to one report. So this is absolutely not a guaranteed win.
Okay, takeaway number 2.
Second, mastering your costs is paramount. Having a precise, detailed understanding of your true all-in costs, purchase, renovation, holding, selling, contingency before you even make an offer on a property is absolutely non-negotiable. Guessing on costs or using fuzzy math is probably the single biggest reason flips fail financially. You have to build that cost science muscle.
Got it. Know your numbers cold. Third takeaway.
Third, success requires way more than just finding a good deal. You have to execute well. That means building a reliable team, especially good contractors, but also agents, maybe lenders, and implementing a repeatable, structured process for planning the renovation, managing the actual work efficiently, and handling the final sale professionally. These systems are essential for controlling both your costs and your timeline, and for ensuring you deliver a quality product at the end.
Right. It's about process and people. What's number 4?
Fourth, location, location, location. Where you choose to flip matters tremendously, perhaps more than ever. The regional performance data we discussed shows enormous variations in average profitability, ROI, and even flipping activity across the U.S. A market that works wonderfully for flipping might be just a state line or a few hours drive away from one where it's incredibly difficult, maybe even impossible, to consistently make a profit. Your local market might simply not be the right market for flipping right now. Do the research.
Crucial point. Don't assume your backyard is fertile ground. And finally,
don't neglect the end game. The selling process itself demands real attention and care. Delivering a quality final product isn't enough if you fumble the sale. Implementing smart disposition strategies like getting that pre-inspection done, using a meticulous punch list for final touches, considering professional staging, and keeping the property impeccably maintained while it's listed. These aren't just optional nice-to-haves. They are crucial steps to protect the profit you've worked so incredibly hard to create throughout the rest of the process.
it really is a complex picture, isn't it? Filled with genuine potential, yes, but also layered with significant hurdles and risks at every stage.
It truly is. And maybe here's a final thought to leave you with. As you reflect on different real estate investment strategies, and particularly flipping,
Okay.
successfully navigating the house flipping world today in this market, it really requires you to become a truly multifaceted, incredibly savvy operator. It's no longer enough just to be good at spotting a fixer-upper, or maybe good at managing contractors.
You need more.
You need to be a diligent market analyst, understanding those local trends and numbers. You need to be a meticulous project manager, keeping schedules and budgets tight. You need to be a skilled negotiator on both the buy and sell side. You need to be a rigorous cost accountant, tracking every penny. And you need to be a quality control expert, ensuring the final product is excellent, all rolled into one.
Wow, that's a lot of hats to wear.
It is. It underscores that flipping today is far less about getting lucky in a rapidly rising market and much, much more about building a specific, demanding set of business skills and executing with unwavering discipline deal after deal.
That's a fantastic point. It really frames it as an active business that demands true expertise and constant attention, not a passive investment.
Exactly right. So perhaps the provocative question to leave you mulling over is this. Given all the complexities we've discussed today, given the very real risks, and given the high level of skill and sheer discipline required, are you personally ready and truly willing to commit to developing and consistently applying that specific, demanding skill set needed to navigate the challenges and potentially capture the rewards of house flipping in today's competitive and dynamic market?
That is definitely something to think deeply about before jumping in. Thanks so much. This has been an incredibly insightful deep dive.
Always a pleasure to dig into the data.